our guests joining in for the show. We have Dhananjay Sinha, who is the co-head of Equities at Systematics Group, as well as we have Kunal Bothra and Naresh Mirani to talk about the markets when you talk about the charts. And Kunal, coming to you, it is the last Friday of the year 2024. Look at the way how the markets have been panning out. They've done absolutely nothing in the month of December, nothing to give us a hope that we will likely even see any sort of a Santa rally in the last few trading sessions of the year.
Yeah, so I think sort of a disappointment as such when you look at this last 1 month. But then I think compared to the kind of correction we'd seen in the month of September, October, I think we would still be happy to have a muted kind of a reaction from the indices. I think we're down just 1.2% odd for the Nifty, for the month, and I think just about 1.5% for the Bank Nifty. But I believe that today's day and even yesterday, I think has been specifically earmarked for many of the sectors which have managed to give a bounce back. So you've seen the auto index, for second consecutive days, many of the stocks are seeing a follow-through up move. That's a very good sign for the sector overall. You've seen the pharma stocks doing pretty well, and many of these pharma stocks are coming out of their individual breakout zones. There are a few mid-cap names, which are seeing volume accumulation. So that's also another positive sign for individual stocks. So I believe that largely, I think we expected the index to remain into a range 23,700, 50, 800 broadly as a pivot range for the index, and that's where the Nifty is just about skirting around.
Okay, levels to watch out for in the near term for the Nifty. But Dhananjay, coming to you, good afternoon and thanks so much for joining us on Closing Trades. Give us a sense of what you are making of the markets heading into next day, especially sectors like IT and pharma. IT not done very well for itself, but pharma and real estate are two sectors that have outperformed the entire street. Do you believe that the rally that both of these indices have seen will continue heading into the next year as well?
So I think from a market standpoint, the market has been fairly choppy in the recent months. I think the key factors has been the fact that earnings season hasn't panned out that great over the last couple of quarters. There has been a sort of a contraction in the profitability of non-finance companies, and I think that is impacting the earnings expectations from a consensus standpoint. So the consensus expectation generally starts with a 16% growth, and I would say that in the last uh, couple of quarters it's averaged about 4%. So there is a downgradation that's been happening. Number two, with respect to the valuations, the risk-free rate, the benign view that market had actually taken is actually challenged with the Fed talking about only two cuts next year. That is also impacting how we see liquidity domestically of what RBI does and the currency, etc. So these uncertainties are there, which is actually translating into some pairing of the valuations. So what we are seeing now is a sort of a easing of that pressure. Typically that happens after a major correction or a phase of correction. What we are seeing today is exactly that. And we are seeing that the concerns has actually eased with the VIX index coming down, both globally and India. So there can be an uptick in the market sentiment in the near term. So I think this market appears to be a rotational market. A lot of trading is happening. I would say fundamentally that the way we look at next year is that in the near term there will be pressure on margins that will continue with the rising raw material cost that is there. So a lot of companies, especially the consumer companies and other companies, might actually see that pressure. We're seeing pressure with respect to metals and cement and infra spending, etc., etc. So all those things are there. I would say that earnings might still undergo correction as we go forward. But I would say that the market would actually favor those segments that can actually see a sort of a consistent earnings outlook, etc. So it's going to be fairly selective in terms of how markets will pan out. I would say that what we are more positive on is the auto space. You mentioned some of it. Basically, we are more inclined towards the rural-oriented sectors, especially agri equipment, tractors, is something that we're liking. We also have two-wheelers, for instance, Hero Motors and TVS are there. So we are kind of selective. We are not so so positive on commercial vehicles and passenger vehicles, because we think that there is a sort of a erosion of value of the premiumization story. So that is something we are sort of betting on. In the pharma space, I think we are overweight there as well. There are some stocks which are likely to show up good results in terms of their outlook and in terms of their product pipeline, etc. So we like the pharma space, and I would say in the current scenario there has been a considerable amount of correction that has happened in the
Right.
consumer space as well. So we'll be looking at some of them, and I think e-commerce space is another place where that we like.
Right. So basically, there are a lot of sectors to watch out for, given the fact that even if we are talking about the year 2025 actually starting on a volatile footing, but looks like there are a lot of sectors that one can watch out for. But I'll talk to you more about that in a short while, Kunal. Actually, not Kunal, Naresh. Let me come to you and talk about the way how the construct has been when you talk about the broader markets. How are the charts looking for the broader markets in particular? Because you saw a maximum shift coming in from large caps to small caps and mid caps, and then you also saw that shift back into the large cap space.
So overall, in the whole recovery, if you look at it, say the Nifty has barely moved up, say at current levels, say from 23,200 lows to 23,800. It's barely a 3% move. But if you look at a small cap, Nifty small cap 100 or something like that, wherein you've moved up from say 17,300, 400 up to 18,800. So it's almost like a 6-8% recovery, or even more in some cases of small cap indices. So clearly, the small caps have done better from the bottoms of November. And even in the recent correction, it's almost similar to what has happened with the Nifty, or lesser than Nifty. And Nifty did not make a new all-time high, but small cap index did make a new all-time high. So the relative outperformance is there. For the last 1 week, we've seen a consolidation for the small cap index. We've not seen a recovery. Same is the case with Nifty. So for now, last 3 weeks, we've been in a band. So one day there is a 500, 600 pointer move on the Nifty, and then we stay in that band. That band right now is 23,500 to 24,000. Once we sustain beyond this band, we get a 500 pointer move.
Little over half an hour left for the trading session to come to an end. And if you look at the markets, right now we've given up from those elevated levels, the advanced decline ratio neck to neck at this point in time. And you see a pretty good churn. When you talk about the list of gainers in trade today, you have Dr. Reddy's, that is the top gainer at this point in time, 2.9% uptick for that one. M&M, IndusInd Bank, Eicher Motors, Tata Motors, all of them holding on to good gains. While on the flip side, Hindalco is the top loser, coming in with cuts of about 1.7%. SBI, ONGC, Tata Steel are the other set of losers. Dhananjay, let me come to you then, and let me talk to you about the entire commodity basket, stocks that are linked to the global commodity price, be it from the oil and gas space, be it the metal space. How are you viewing all of these sectors, and do you think that they are a bet to play or to take for the longer term, given the fact that these stocks are also dependent on what happens globally when these commodity prices move?
Absolutely. So we are kind of conservative on the space, and I think this space offers trading opportunities from time to time. But I think structurally, it is exposed to headwinds, especially in the context of what is happening globally. First thing is that you have a very strong dollar scenario that is panning out with whatever is happening in the US. The rate cuts have actually been reduced. So 2 out of 4 that was expected for next year. So that's number one. And you have other currencies also sort of euro in particular actually weakening for the fundamental reasons that are there. So I would say a strong dollar is not a very positive thing for a metal space. So that's number one. Number two, we are seeing the impact of trade conflicts that could accentuate going forward with a Trump to regime taking more stricter actions against, or tariff actions against China. And also I think that uncertainty with respect to the outlook for Chinese economy and the demand for that might actually be on the weaker side. And we know that China has been sort of dumping various products across the world, and more so for metals, because they are roughly about producing roughly about 55% of 50 to 55% of all the metal production that is there. They're also a consumer, but I think in a context where there is trade protectionism and there is a slowdown in China, the pressure on Indian companies with respect to the prices would continue. So I think if you look at the HRC, for instance, HR steel prices roughly trading about 25% lesser than Chinese products are actually trading 25% lower than Indian steel. So I think the pressure on the Indian steel makers will continue, and as a result of that, we are seeing that companies are asking for import protectionism against Chinese dumping, and some companies are talking about rolling back investment plans, etc. So I think if you look at the entire basket, it does look like there are a lot of uncertainty. So I would say that I would stay away from the sector, given the context that some of these headwinds could be structural in nature. I think if you the way to play this is to really look at auto space where you have a resilience in volume and there can be expansion in margins because of that. So as I said, agri equipment, especially tractors and all, can benefit in that context. So I mean, we look at a sort of a pair trade where you look at sort of being low on the metal space and sort of compensate that by higher weightage for some of these consuming companies such as auto.
Okay, thanks Dhananjay for that view coming in. Kunal, give us a chart check on some of these shipping stocks that have been a buzz. Cochin Shipyard, of course, we have news flow, so that's locked upper circuit of 5%. What's making Garden Reach go higher by 9.5%, 10%? And do you believe that this kind of exuberance that both of these stocks are seeing just today on an intraday basis can continue going ahead? What are the charts looking like for a couple of these shipping names, the likes of Cochin, GE Shipping? You have SCI on one hand, Garden Reach. Give us a broad check on what the charts of these companies are looking like.
So I'm bullish on the entire space. My belief is that the year 2024 has played out into two parts for many of these shipping stocks. There was a point where start of 2024 these stocks were just about continuing from their last 2 years of major uptrend as well as a rally, and mid of 2024 somewhere, I think the month of July or August thereabouts, is where these stocks topped out. There was a point where these stocks corrected by 20-30% initially, and then what followed was an inertia selling where these stocks consistently drifted lower. Some of them, for example, Garden Reach, etc., managed to drift back lower towards their 200 moving averages. Some of them had managed to break below their long-term moving averages. So which means that we've gone through a classical point of a significant upside for these stocks in the first half of this year. In the latter half was where these stocks went through a price correction as well as a mean retracement. Now these stocks are poised at an extremely attractive risk reward, because we are looking at a juncture where these stocks have gone through a dull kind of a zone on the back of the corrective phases. Volume activity is starting to rise for these stocks. These stocks are not closer to their lifetime high levels, but they are just about some 10% to 15% higher from their previous swing lows. So I think in that aspect, I would believe that these stocks look fairly attractive. I also believe that there could be a point where, say in 2025, these stocks may get into a gradual kind of a rise. And I've assessed the charts for these names on a historical basis, that what happens when these stocks correct by a margin of 20-30%. It's not a V-shaped rally or a recovery which happens into these names. There is an initial period where these stocks slowly and gradually gain pace, volumes pick up for these stocks, and then once these stocks come very close to their lifetime high levels, that's where the momentum accelerates and you see these stocks showing extremely strong price activity. So I think we are still in that zone 1 where these stocks are gradually trying to move up higher, and that's why I think buying these stocks at current levels could be very attractive.
All right, so that's a take coming in on some of these shipbuilders, shipbuilding companies. On that note, thank you so much, Dhananjay, for joining us on the show and sharing your views on the various sectors that one can watch out for. And before we actually slip into a break, let me take closing trade picks coming in from you, Naresh, as well as Kunal. Naresh, go first.
So that would be about Sun Pharma. The stock has given a short-term range breakout in the last couple of sessions. And has been showing a lot of related strength. So expecting this to break out and slowly go towards 1900, 1950 would keep a stop loss below 1850 now.
Okay, Sun Pharma looking good to Naresh. Kunal, what about you? What's your closing trade for the day?
So I'll go with the buy on Laurus Labs. That's a chart which is looking attractive. Very close towards breaking the previous major highs of 600 thereabouts. So expecting the stock to climb up to that 600 plus levels and then move on to that 630, 650 mark.
All right, so those are the closing trade picks coming in from our experts then. But it's time for us to slip into a break on this edition of Closing Trades. But before that, Adani Port has placed India's largest order for 8 state-of-the-art harbour tugs worth about 450 crore rupees. The tugs, to be built by Cochin Shipyard, will enhance the maritime infrastructure and boost local manufacturing. The delivery is expected to begin in December 2026 and be completed by May 2028. This move aligns with the government's Atmanirbhar Bharat initiative promoting self-reliance in the maritime sector. Adani's total fleet will increase to about 152, significantly improving vessel operation efficiency and safety in Indian ports.
If you like this video, then like, share and subscribe to ET Now.